Hello, my name is Carsten Müller. I'm an assistant professor of finance at the National University of Singapore, and today I will be talking about bank runs. Now, bank runs are something that has come back into the popular study in economics because of some recent events, both in the United States, where we saw a massive bank run on Silicon Valley Bank, and also in Europe with the events surrounding the demise of Credit Suisse. But of course, there's a long history of bank runs and their study in economics and in finance. But much of that work has been on the theoretical side. In fact, if you look at the recent Nobel Prize in economics that was awarded for the study of bank runs and financial crises, a lot of the underlying work actually tries to explain the theoretical mechanisms through which bank runs may be related to the broader economy, but not much of that work has been empirical, not so much informed by the data. And so what I tried to do in some recent research with my colleagues Tobias König, Fazat Saidi, and Rostam Jamilov is to shed some light on the relationship between bank runs and the macroeconomy using some new data. And so in particular, what we're doing is to construct two new data sets that allow us to really flesh out how a bank run's related to the macroeconomy and what might be the underlying mechanisms driving this relationship. So here's what we do. First, we create a new chronology of which country has experienced a bank run or several bank runs in which year over a long historical time period. So we cover basically every modern country in existence going back all the way to 1800. And this information comes from existing work by financial historians, it comes from work done by individual central banks or financial regulators that they publish in specific documents, it comes from news reports at the time. And so whenever possible, we really try to see in these sources, can we say that really at the point in time when the source was written, people were worried about there being a bank run, to avoid kind of a bias from only using more recent information. So with that, going through hundreds and hundreds and hundreds of individual sources, we get this new chronology where we can say, okay, during the Great Depression, these are the countries, for example, that experienced bank runs, or during the 2007-8 financial crisis, these were the countries that experienced bank runs. The second data contribution that we use is a new data set on the outstanding deposits of the banking sector in each of those countries. These data have also been published for very long time periods, also starting in 1800 or sometime in the 19th century in many cases. And that is nice because it allows us to say something quantitative about the liability side of the banking sector. Because after all, a bank run means that depositors suddenly withdraw some sizable fraction of the liabilities of the banking sector. So measuring that in a quantitative sense, we think is also important. And so when we put these two data sets together, we get kind of three different types of events that we then study, where we're then interested in what are the drivers, what are their consequences. And those three events are, number one, bank runs that are simply coinciding with deposits of the banking sector continuing to grow. So they are bank runs in terms of the historical evidence we have. People say somebody was running on the banks, but in the aggregate data, we don't see there being a drop in aggregate banking sector deposits. The second type of event are deposit contractions. So we do see that the deposits of the banking sector go down, which might be because of a recession or changes in monetary policy or wars or any other factor, but we don't have evidence of a bank run. And number three are what we think of as the perhaps most relevant events, which are bank runs that are also associated with a decline, a contraction in aggregate banking sector deposits. And these types of bank runs, so those where we see that people are withdrawing money from the banking sector as a whole, these bank runs we call systemic bank runs. And we try to differentiate them from these more idiosyncratic episodes. So bank runs where people may not be withdrawing money en masse, and so they don't show up as a contraction in overall banking sector deposits. Now, equipped with those variables, we can ask a couple of questions that we think are relevant for understanding why should anybody care about bank runs in the first place. So the first thing we document is that bank runs are typically associated with a large decline in real GDP and real GDP per capita. So that means once a country has experienced a bank run or a wave of bank runs, this has kind of long-lasting economic costs. It makes the country poorer over time. We also see that those bank runs are associated with a credit crunch. So we see that also lending by the financial sector goes down, and perhaps not surprisingly, no matter what kind of event we look at, we also see a contraction of deposits of the banking sector. And so that is kind of one of our baseline results where we try to quantify, what are the macroeconomic losses of bank runs. And the most important takeaway in terms of mechanism we have is that it is really bank runs associated with times when the banking sector faces solvency issues that are particularly bad. And we have two pieces of evidence for that. So number one, it is bank runs that are accompanied by a wider banking crisis that are associated with these deep output losses. If you don't have a crisis coinciding with a bank run, not so much of an issue. If you look at individual banks, we see that during these systemic bank runs, depositors particularly run on banks that have solvency issues. So those that, for example, go into the run with a high degree of leverage. And so both of these pieces of evidence tell us that it's really the interplay of being exposed to bad shocks because of solvency issue with a bad shock arriving, in this case a bank run, that may be at the heart of deep financial crises that are associated with long-lasting recessions.